So I think the three key takeaways for entities in the energy and natural resources sector are really fundamentally limited to those in the petroleum resources sector or subsector. And they concern the treatment of exploration expenditure, number one, the deductibility of mining, quarrying and prospecting rights, so when those amortization periods start to commence. And thirdly, again, with respect to PRRT, the introduction of a cap so that only 90% of an entity's income can be sheltered in any one particular period. And I'm happy to now walk through each of those three changes in turn. The first budget announcement is that the definition for PRRT purposes of exploration will be limited so that it only includes costs associated with the identification, the finding a resource and the extent of that resource, and not those ancillary costs that go towards working out whether it can be extracted commercially. The second change is there is a new cap that has been set on the limit of deductions that are available for entities in the PRRT industry. That cap essentially, subject to some more information that we need to get in due course around how certain expenditure like starting base will be treated, is that the cap will be limited to 90% of the income. So essentially there will be 10% of the profit for TRP purposes, or there'll be a minimum 10% profit for PRRT purposes. And that has the effect of bringing forward when the PRRT liability will otherwise arise. So the government is bringing forward the cash tax liability for those entities. The third change is around the treatment of mining, quarrying, prospecting rights, again for entities, for PRRT entities. This is another change that emanated from Shell's success in the court, where Shell was able to start to deduct a mining, quarrying, prospecting right from the time that it held the right. The law is being changed, prospectively in this case, such that now they'll need to, it's not from when the asset is simply held, but from when the asset is used, and we'll need to figure out what that actually means in due course. I think with all the budget measures, there requires further detail before we can make any meaningful comment as to how the rules will apply. There was one concerning comment where there really wasn't much detail at all, and I'll just read, if that's okay for a moment. It says, the government will limit the circumstances in which the issue of new rights over areas covered by existing rights lead to tax adjustments. Now that's straight out of the budget paper, and we really don't know what that means at the moment. There's a concern that it may change the classification of how assets will be treated for tax purposes, and we'll really just need to see more detail in respect to that change. Taxpayers that had followed the Commissioner's ruling, which was put out as said in draft in 2013, the finalised ruling was in 2014. For those that had followed that ruling, then there's no changes that need to be made. For those entities that have adopted the position that Shell took, or have subsequently adopted the position that Shell took, then they will need to amend their tax returns in respect of that retrospective change. And they will need to understand in due course how those amendments will be processed in terms of whether penalties will be applied, because obviously those taxpayers who have adopted the position that Shell took have taken the correct position as the law is at the moment. There's going to be a deferral of deductions, so those costs in respect to feasibility, etc., those costs are not deductible for PRRT purposes, and they'll go into the base and they'll be deducted over time. So that is a cash flow issue and therefore an NPV and evaluation consequence. Similarly, the cap on the deductions, the 90% cap on the deductions, that has the exact same consequence in terms of it accelerates when the cash tax payments are due and therefore reduces the value of assets. There were other changes. There are some other things that weren't in the budget that we kind of hoped would be in the budget. In particular, and this is much broader than now entities operating in the energy and natural resources sector, The key thing that we were hoping would be, and there would be some clarification around the treatment of companies which have their central management and control in Australia. So this is an area of real uncertainty in the law at the moment as a consequence of another court case several years ago. There's been some transitional relief or administration, shall we say, that's been applied by the tax office. That ends at the end of next month. It's been extended on numerous occasions. The Board of Taxation had announced or had looked at the corporate residency rules and recommended some changes to government. The previous government made a budget announcement around the adoption of that recommendation, but we haven't seen anything on that, and we haven't seen any further announcement in the 23 budget on that measure.